Have you ever traveled to another country and stopped at one of those airport kiosks to swap your home currency for foreign cash? Let's say you hand the clerk 1,100 US dollars, and in exchange, they give you exactly 1,000 euros for your trip. But then your flight gets canceled. You go home, and a month later, you head back to the airport to swap those exact same euros back into dollars. Only this time, the clerk hands you $1,150. Without doing any actual work, you just made $50. That happened because the value of the euro went up while it was sitting in your wallet. And that simple exchange is the exact foundation of Forex trading. Now, take that single airport kiosk and imagine a massive digital network connecting major cities all over the planet, operating 24 hours a day. In places like Tokyo, London, and New York, trillions of dollars are constantly shifting back and forth between different countries as global trade happens. Because this modern market is entirely digital, you don't need a plane ticket to participate. Anyone with a computer can connect to this global exchange from home. To make sense of all these different currencies, the market uses something called a currency pair. It's simply a way to put a price tag on one country's money using another country's money. Let's look at the most common example, the euro and the US dollar. When paired like this, think of the first currency, the euro, as the physical product you are buying off a shelf. That makes the second currency, the US dollar, the method of payment used to buy that product. Reading a Forex pair tells you the exact cost of one single unit of the first currency, paid for in the second currency. Those prices never stay still. They drift up and down all day based on breaking news and how strong or weak a country's economy looks at that exact moment. Traders track shifts using Japanese candlesticks, which show price movement over time. If the euro strengthens against the dollar, traders place a buy order to capture upward movement. If the US economy strengthens instead, a sell order profits as the price drops. Charts give us a clear picture of what happened in the past, but predicting the future is impossible, and markets can drop suddenly without any warning. Because no one can predict the future, long-term success isn't about being right all the time. It is about surviving your inevitable mistakes through strict risk management. This diagram shows the first rule of survival, the 1% rule. If you have a total account balance of $1,000, you limit your exposure to just $10 on any single decision. By risking such a tiny fraction, even if a trade fails, 99% of your account is still perfectly intact, so you can try again tomorrow. This chart shows the second rule, the stop-loss order. Think of it as an automatic eject button you program into the system before you even enter the market. It completely removes human emotion from the equation. It closes a bad trade automatically, stopping a small, manageable loss from turning into a total disaster. When you combine these tools, you get the risk-to-reward ratio. Traders mathematically stack the odds in their favor by agreeing to never risk their 1%, unless the potential gain on the table is at least double that amount. When you strip away the charts and the numbers, Forex is really just a high-speed global version of that airport exchange booth, governed by discipline and mathematical rules. Using tools like currency pairs and strict risk management is the only mechanism that separates a professional trader from someone blindly gambling. If you want to learn exactly how to read these charts and safely execute your first practice trade, hit the subscribe button so you don't miss our upcoming step-by-step guides.